And 72% of the time the market goes up. And the answer came to me. And that's when I developed my chart. The answer came to me is because, just like Caterpillar, when they pull their money out, you get out. Whoa.
It's your daily dose of how to manage your money. And now it's time for Phil's Gang on the Off the Wall Street Network.
Oh, God. I get nuts.
With your host, Phil Grande.
Bye. Thank you for joining my podcast. We certainly have a lot to talk about today. Now, the first thing we could talk about is how come yesterday, when the market was down about 900 points, it all of a sudden turned around and was only down 300 points. And matter of fact, I think it turned positive. And how come today, when the market was down 1,100, it's turned around and now it's only down 285 points? Is that magic? No, that's manipulation. So let's talk about that too. So we're going to talk about that. And we're going to talk about why is it that 70 to 90% of the retail investor loses money? Well, because he's told to follow fundamentals. But fundamentals have been closed down since 2008. But it's hidden. Nobody wants to talk about it. Because if you start to talk about fundamentals being hidden, there'd be no industry for crooks or thieves. There'd be no Wall Street. So let's start with what happened today with the market. So oil prices took off. Now we're doing well because we've been long the ETF, XLE, and some individual stocks, but that's neither here nor there. Okay, so Iran closed the Strait of Hormuz, sorry about that. So oil prices spiked. Brent went up about 8%. I followed WTI, went up about 8%. That means inflation. Now, the Fed should raise rates to stop inflation, because after all, we're told that the economy's doing terrific. Go ahead and play the cut. Willie, can you play the cut?
We have the strongest economy in the world.
The strongest economy, but we don't. That's a bold-faced lie. That's why they could not raise the rates. So here we got oil spiking. That's inflation. Everybody knows that. Gasoline goes up, food goes up, everything goes up. But that can be fixed easily. If you have a strong economy, play that again.
We have the strongest economy in the world.
Yeah, well, then why don't you just raise rates and fight inflation? That's simple. Well, it's a lie. That's why they can't do that. So they've been lying about this good economy. So you can't you can't cut rates in a bad economy with inflation, right? So now there's no rate cuts. Everybody's been telling we're going to get these rate cuts. So what happened is investors started to dump their bonds because when they know inflation's going to go up, because oil's going to go up, and they know the Fed can't raise rates because the economy sucks, they get nervous. So the first thing they do is they turn around and they start dumping their treasuries. That's what happened. And when you dump treasury, yields go up. When you buy treasury, yields go down. So they're going up. So that's what happened. So that's why oil prices shot up. We couldn't control it. Even though we know it's a lot of inflation is going to occur, we couldn't control it by raising rates. It was, it was out of the bag. Our economy's not doing well, so we can't raise rates. So that's what happened there, and that's why oil's going up. And then when oil goes up, yields go up. Yields are going up. That means the dollar's going up, and that's why gold, which normally would blast off on a day like today, is not going up because it's going down because the dollar's going up. So everything's backwards today because they've been lying about the economy, and that's what terrible thing. And that's why you should never lie about the economy. But everybody does. So that's what happened today. So, and everybody's going, why isn't gold going up? Why is it going up? Well, I just told you it's not going up because when they're dumping and selling their treasuries, their bonds, yields are going up, dollars going up. That's not good of course, for gold and silver. So that's that problem. So now, how did the market turn around yesterday? I think, what was it? Well, it was down 800, 900, and then went positive, and then doing the same thing today. Today we were down 1,100, now we're down 291. What was it yesterday? Do you remember? It went about 880 and came down to about, it went positive yesterday. Well, how the hell did they do that? Well, it's called the plunger team, or the President's Working Group on Financial Markets. Now, when we have a negative pre-market or correction during the day, it's the plunger team who makes the decision to pull the trigger to execute a coordinated effort between the Fed's primary dealers, JP Morgan, Goldman Sachs, Morgan Stanley, and Citi, the future desk, and arbitrage players. Now, what does all that garbage mean? It simply means that the President of the United States sits there with a team, and they decide, we got to get this market, going back up. Now, Trump will never let a market be down 1,100 points very long. I told my members that this morning. I said yesterday we were going to go positive. Look at this. We're only down 240 points. Here's how it works. When Trump gets upset and he sees the market's down 1,100 points, 300 points yesterday, what he does, he calls his plunger team in. They then order the Fed to take its primary dealers, JP Morgan, Goldman Sachs, Morgan Stanley, and Citi, and then to order the future desk, and then order the arbitrage players, the biggest arbitrage players in the world, to then set or pull the trigger on a robotic automated trading system that will open up and start buying millions and millions and millions of shares. And that's how the market went from 800 to positive yesterday, and that's how the market went from 1,100 points down a couple hours ago to it's 274, may even turn positive, because the plunger team orders, again, the system that's put in place to stop markets from falling. That's simple. That's what happened. So it's not the plunger team who goes in and buys stocks. It's the power the plunger team has to order the Fed's primary dealers to take to the future desk, to take to the arbitrage players, and make sure that they execute the robotic automatic trading system that will go in and buy millions and millions of shares. That's how that happened. So now you know how we have this beautiful turnaround every time the market, and why the market doesn't go down anymore. But it will. Now, the other big problem the market has is that 70 to 90% of the traders lose money, retail traders, because they're being lied to. Because they're being told by the TV jibber-jabbers and the analysts, everything's wonderful. Play the cut.
We have the strongest economy in the world.
And the other cut. This is another analyst.
New Mountain Finance just done $477 million of assets. It's only 94 cents on the dollar. That's a brutal 6% haircut on nearly $500 million. And they called it increasing portfolio diversification and reducing PIK income. But come on, nobody eats a loss like that just to diversify. Look at their stock. It's already down more than 40% in the last 12 months.
My hair's hurting. So that's a typical analyst, right? He's going to give you all these fundamentals that don't mean anything anymore, because fundamentals stopped working after 2008. Now, so the reason that 70 to 90% of retail investors are losing money, because it's these jibber-jabbers, these analysts who keep pushing them towards fundamentals. But remember, fundamentals stopped working in 2008, and it was official, made permanent by 2013. But you notice nobody talks about it. Now, the Fed took over the market in 2008. Do you remember we had that big crash, and then we started with QE? The Fed took over the market with liquidity. Liquidity is everything. So what they did, liquidity, and of course, the big institutions, there's 13 of them, took over the algorithms. But now price moves only on money flow. Money, the only way you can get money, the only thing that moves the stock market or moves stocks is institutional money. That's the only way you get things moving. That's it. Okay? They push that money. They push their balance sheets are so strong, so powerful. They push their institutional cash through channels to stocks that they're going to buy. They control everything. Fundamentals have nothing to do with why a stock goes up or stock goes down anymore. That stopped in 2008 when the Fed took over and the market with producing massive liquidity. So again, earnings, PE ratios, none of that stuff moves stocks anymore. It's all a lie. It doesn't work that way. So people are losing money left and right because they're told to follow fundamentals and you're going to be fine. But again, the retail investors trust these TV jibber jabbers and these analysts because they sound so smart. Right? You heard this guy. So the majority of retail traders are referred to as tourist investors because they have a herd mentality. And that's what makes them different from retail investors who want to learn and think independently. That's what makes them different. So the fundamentals, okay, like credit spreads, double pledging, PE ratios, accruals, book value means nothing. Fundamentals stopped working in 2008 when the Fed took over the market with liquidity and the big institutions took over the algorithms. Now price moves by money flow only. That's it. But you're not going to be told that. So when the financial system blew up in 2008, the Fed did something only they can do. They put out the printing machine. They created trillions and trillions and trillions of dollars electronically. Not borrowed, not taxed, not saved, not... They just print it. And they used it to buy what? Treasuries and mortgage bonds and assets, bank assets. They flooded the banking system with so much cash. Think of it. Like the Fed opening a giant fire hydrant and blasting money into Wall Street. That's what happened in 2008. The money flowed into the 13 biggest institutions. Once the Fed blasted the system with all this liquidity, it didn't go into the small banks. It didn't go into mom and pop investors. It didn't go into retail traders. It didn't go to local business. It went to the largest financial institutions, 13 of them. And here's how the system works today. So what they do, the institutions have all this money. Where did the money come from? The Fed created all this money in 2008. By 2013, there was so much liquidity created, they gave it to the 13 institutions, and they're the ones that push the market. And what they do is they push their money through pipelines. Think of them as pipelines. Think of them as a big reservoir they push the money through pipelines. Now, these are players that, again, like Vanguard and Fidelity and State Street and J.P. Morgan, all these kind of players. All right? Now, these are the firms that are the pipelines. Okay, and all this money flows through them. And it's like a distribution system. Those 13 institutions decide where the money's going to go next. This is what retail investors don't understand, and they sit there every day and they buy a stock based on some damn fundamental that doesn't do anything. It's dormant. They're gone. They're frozen. But they're not going to tell you that because there'd be no room we don't need analysts anymore. We don't need jibber jabbers anymore. The only thing that works is pushing money. Those big 13 institutions loaded with money, they push that money through ETFs, through indexes, through futures, options. That's the pipeline. And when they decide what stocks they want to go up, they'll push that money directly to the stock. And what you got to do is keep following the money. They leave a big footprint behind. And when you follow that money, you know exactly what stocks they're buying. Those are the stocks that you should be buying. But no, the jibber jabbers and the analysts want you to buy stocks that they benefit from. Well, they'll come on and do this. Do that again. They play the cut with this analyst, what he's talking about.
New Mountain Finance just done 477 million of assets. It's only 94 cents on the dollar. That's a brutal 6% haircut on nearly $500 million.
Okay, enough. Who the hell cares? It doesn't do anything. Fundamentals don't move stocks. You got to understand. Institutions move stocks. Those are the four big asset managers, the four biggest banks, the three biggest hedge funds, the biggest bond house. Liquidity is how these institutions move money through those pipelines. They move that liquidity. Their balance sheets are so strong, so powerful. They have the ability to push their institutional cash through those different channels. And now they target what stock is going to go up, what stock is going to go down. And if you follow them, buy the same stocks, you're going to be making money instead of 80, 90% losing money. And that is the truth.
Are you nuts?